Do you dream of achieving financial freedom and building substantial wealth? This guide is here to lead you on an exciting journey toward financial success. Packed with invaluable insights and actionable strategies, it equips you with the tools you need to navigate the dynamic and ever-changing stock market landscape like a pro. Hello, this is Samuel Farron, and you are listening to Stock Market Investing for Beginners. How to build wealth and achieve financial freedom with a diversified portfolio using index funds, technical analysis, options, penny stocks, dividends, and REITs. Provided to you by United Audiobooks. I hope you enjoy my audiobook. Now, let us begin. Introduction. Do you check the newspaper in the morning to see how the market is doing? Do you focus on the TV to find the next likely share increase? Do you fret constantly about the money you have in stock market investments? Say no more. It's time to make a wise investment so you can get a decent night's sleep. This book will help you increase your investment and stock market expertise. As a beginner, you will become knowledgeable in investing in the stock market. You've probably been told that you need to start saving for retirement since you got your first job out of college. Investing in the stock market is the most recommended way to achieve that. When you read the news about the market's rapid fluctuations, it may appear risky. While stock values fluctuate daily, they rise over the long term and beat other investments like bonds and interest-bearing bank accounts. Because of this, stocks are seen as a suitable investment for those who have a significant amount of time until retirement. The popularity of stock market investing has steadily increased over the past 20 years. However, market volatility continues to be an area of concern. If you're a beginner and want to invest money in the stock market, these volatilities could significantly impact your portfolio. You can potentially experience losses in the absence of a trading strategy. It's common to get intimidated by the stock market and its jargon. This book will provide you with the knowledge you need to understand how the stock market operates so you can start investing in building your retirement fund. So, continue reading to know more about how the stock market operates. Learn more about the various types of stock markets, the reasons behind price fluctuations, how to buy in and trade stocks, and more. Understanding the stock market. Do you ever feel like you're listening to strange language when you hear about the stock market? One that you truly want to understand but just can't? You're not alone. That much is certain. We can help you better understand the stock market and how it operates so that investing doesn't seem overwhelming. What are stocks? Let's dissect it, beginning with the basics. Stocks, usually called equities, are financial instruments representing a portion of ownership in a publicly listed corporation. So, when you purchase stock in a firm, you effectively become a stakeholder. The unit of stock is called a share, and the more shares you purchase, the more stock you own in a firm. Companies issue stocks to raise capital for business expansion. There are primarily two kinds of stocks, common and preferred. The major difference between the two types is that while preferred stocks do not allow shareholders to vote on corporate decisions or share in the company's expanding profits, common stocks do. Preferred shares offer a higher fixed dividend payout. What is a stock market? Consider the stock market as a network of stock exchanges where investors and traders can buy and sell shares of publicly traded corporations. This is a simple way to think about the stock market. Initial public offerings, or IPOs, are a way for private companies to sell their stock shares on the market. These shares are bought by investors, enabling the company to raise funds from the general public to expand its operations. Investors can buy and sell the company's shares on an exchange that tracks the stock price once the company has been listed on a stock exchange and has become a public corporation. The price at which buyers and sellers of securities are willing to transact is influenced by supply and demand. How does the stock market work? To fully understand how the stock market works, it helps to know that there are two different markets, the primary and the secondary. Securities are produced on the primary market, where a corporation issues its stock through an initial public offering, IPO. Remember that an IPO occurs when a firm first lists its shares publicly. These shares and thousands of other equities are bought, sold, and exchanged daily on the secondary market, essentially the stock exchange. There are two primary categories of investment methods when trading shares on a stock exchange. As the name suggests, day trading is purchasing and selling the same shares inside a single day, with trades occasionally lasting only a few minutes or even a few seconds. The goal is to profit from minute price variations. Then there are longer-term trades or investments where the buyer keeps the shares for extended lengths of time to benefit from the company's earnings growth over the long run. The stock market has two key purposes. First, it helps companies in obtaining funding from the general public, often referred to as capital, by selling shares that can be used to finance and grow their operations. Additionally, it offers the investor who buys those shares a chance to participate in the company's profits. One of two approaches exists for investors to gain from stock ownership. Some stocks offer a return on the amount of money invested in the shares through periodical dividend payments, a certain amount per share. As an alternative, capital appreciation is another way to make a return, which happens when the stock price rises. Why invest in the stock market? Over time, the stock market has generated a tremendous amount of wealth. The S&P 500, which comprises 500 of the biggest publicly traded companies in the U.S., has provided an average return on investment of 8% to 12% annually. An investment of only $10,000 in the stock market 50 years ago would now be valued above $380,000. However, remember that the stock market doesn't always go up. Every 10 years, the S&P 500 normally declines 3 times. Because of its high level of volatility, certain losses might feel rather harsh. Stocks, however, have the potential to generate much better returns than other investment options over the long run if you can manage your fear. The benefits of stock investing are numerous. Here are the top 7. 1. The chance to get better returns. The prospective return versus alternatives like bank certificates of deposit, gold, and treasury bonds is the main reason most investors choose stocks. For instance, since 1926, the average yearly return on the stock market has been around 10%, whereas the average annual return on long-term government bonds has been between 5% and 6%. 2. The ability to guard your assets against inflation. Returns in the stock market often exceed inflation rates by a wide margin. For instance, from 1913, the long-term inflation rate has averaged 3.1% every year. That is comparable to a stock's double-digit annual return. Stocks have historically been a reliable inflation hedge. 3. The ability to consistently generate passive revenue. Many businesses provide investors with dividends or a cut of their profits. Although some businesses pay dividends regularly, most companies pay them quarterly. An investor's paycheck or retirement income may be supplemented by dividend income. 4. The satisfaction of ownership. A share of stock denotes a portion of ownership in a corporation. You can get a small stake in a business whose goods or services you adore. 5. Liquidity. Most equities are traded openly on a significant stock exchange, making acquiring and selling them easy. It also makes stocks more liquid than other investment possibilities like real estate investments you can't easily sell. 6. Diversification. Stocks make it easy to create a diversified portfolio that spans numerous industries. This can help you diversify your investment portfolio, including stocks, bonds, and cryptocurrencies like Bitcoin, lowering your overall risk profile and raising returns. 7. You can start small. Investors can start buying less than $100 stocks because many online brokers provide $0 costs and the option to acquire fractional shares. Risks of stock market investing. As an investor or trader, you often encounter the disclaimer, investments in securities markets are subject to risk. Have you ever considered the kind of risks that are common in the securities market? If you are an investor who has been investing in the stock market for some time or a novice investor who wants to give it a shot, you must understand the many risks that could impact your investment. Our goal is to help you. This section introduces you to the main securities market risks. Market risk, or systemic risk. It is the risk that investments face as a result of the market's and the country's overall economic performance. Rather than a single corporation, the risk is the fall of an entire market. Some examples of systemic or market risk are Black Monday in 1987, the stock market disaster on September 28, 2008, and the market meltdown in March 2020 brought on by the pandemic. Systematic risk is often unpredictable because it affects the entire market ecosystem. A few strategies like hedge portfolios, contra-market return products, and known correlated market goods exist to mitigate the effects of systematic risks. Unsystematic risk. Unsystematic risk, as opposed to systematic risk, is the risk connected to a specific business or sector. It is also called non-systematic, specific, residual, and diversifiable risks. Unsystematic risk factors include things like new competitors entering the same industry, ineffective management, flaws in the company model, adjustments to the capital structure, production of undesirable goods, labor strikes, etc. The unsystematic risk may be a business risk, which occurs when operational, financial, or market situations negatively impact a company's activities. Unsystematic risks can be minimized because they are diversifiable. By diversifying your portfolio, you can somewhat reduce the unsystematic risk by purchasing shares of several firms and industries. Inflation risk. Inflation risk, also known as buying power risk, is the risk that implies that the cash flow from an investment would depreciate later due to a reduction in its purchasing power due to inflation. All investment types carry some level of inflation risk. The risk of inflation is time limited. One method to avoid inflation risk is to make adjustments to your portfolio and to choose investments that provide a higher rate of return after accounting for inflation. Liquidity risk. Liquidity risk develops when you can't acquire or sell your investment quickly enough. For instance, you might desire to sell securities from a small cap business to direct the proceeds to another asset class. However, you run the danger of running out of liquidity if you can't find any purchasers to sell those securities to. Before purchasing any asset class, look at the traded volumes to minimize liquidity risk. Volatility risk. Volatility risk develops when a company's price swings over time. Consider price stability, traded volumes, previous price swings, and other factors to reduce the volatility risk. Cash flow risk. Also known as currency risk, it is the potential risk of financial loss brought on by changing exchange rates. When you invest in foreign currencies or instruments that are exchanged in foreign currencies, you run the risk of experiencing this. Listed above are the possible risks associated with your investments. Although you cannot completely avoid these risks when investing, you may reduce them with various tools and solutions. Here, we have introduced you to the risks in the entire securities market. Before investing your money, you should consider the risks and potential rewards. There is no risk-free return. Therefore, weighing the risks and rewards should be a key component of any investment decision. Setting investment goals. When you invest for your future financial stability, you effectively allocate your money to an asset that was made to enable your funds to increase in value over time. If you're considering your financial goals, you probably have a clear notion of what you hope to achieve with your money. Knowing your needs, goals, and level of risk tolerance is an excellent place to start. However, you must also consider other elements that will affect your investment goals, such as your income, age, and perspective for the future. Considering your investment goals carefully will serve you well, keeping in mind that time will be a key component. How quickly you want your money out will greatly impact how you establish your investment goals. Determining your investment goals. According to studies, more than half of American workers are behind on their retirement savings. The ultimate financial goal for many people is retirement, so why do so many fall short? Failure to establish and maintain specific investment goals over time may be one of the causes. If you can't identify your goals in the first place, achieving them won't be easy. Even though beginning as a new investor can be frightening for some, knowing your top priorities can increase the likelihood that you'll succeed in achieving them. It would help if you took the time to consider what's essential to you before defining particular investment goals. Do you intend to have children? When do you intend to retire? You can learn more about what matters to you by considering the answers to questions like these. From there, you can begin defining your financial goals, which are any life events for which you'll need to start saving and investing. Retirement, getting married, having kids, and purchasing a home are all common examples of investment goals. Here are some steps that will help you set and achieve your goals. In light of that, here's how to make a practical plan for accomplishing your investment goals within a set time frame in light of that. 1. Goals. Think about your motivations for investing. Money making is the main purpose of investing, but other factors are also involved. What will you do with this money? Suppose it's for making up an income deficit, retirement planning, paying off existing debts, or purchasing another asset. In that case, you should be ready for a mid to long-term commitment, often lasting at least 5 years. Saving might be better if you aim to get rich before then. 2. Risk. Consider how much risk you will take. Your investment's value may increase or decrease. Ultimately, your investment goals and objectives will rely on how comfortable you are taking risks. Consider where you can take risks and where you can't while considering your other financial goals. For instance, if you're getting close to retirement, you'll want to avoid significant losses before withdrawing your funds. 3. Time. Determine your time frame for investing. Generally speaking, the longer your money is invested, the greater the chance it will increase in value and help you achieve your goal. However, how long you invest will depend on the results you hope to achieve. Anything you'll need money for in the next 5 years or less is typically seen as short-term, whereas goals outlined over the next 5 to 10 years are regarded as mid-term. Long-term goals often span timeframes of more than 10 years. 4. Plan. Create an investment strategy. It would help if you found any appropriate investment options when you are clear on your objectives and goals and after you have thought about how much risk and time you can accept. Generally, beginning with a low-risk investment, such as cash ISAs, is advisable. Unit trusts and other medium-risk investments should be included if you tolerate increased volatility. You won't be prepared for something with a higher level of risk unless you've amassed several low and medium-risk investments. 5. Diversify. Build a diverse portfolio. Making a balanced, diversified investment portfolio is one of the most effective strategies to guard against the market's ups and downs. The economy, interest rates, politics, wars, and weather can all impact investment. What's good for one investment could be bad for another, so when one does well, another might underperform. Therefore, investing all your money in one type of investment is dangerous. Time horizon and risk tolerance. Your time horizon is when you anticipate holding an investment before requesting a return. Will you need the money you intend to invest in a few months, a few years, or decades? Your time horizon is important to take into account while selecting assets. It's critical to consider how long you will need to invest to achieve a specific investment goal. To help you achieve goals with various time horizons, your portfolio can contain a variety of investments. Short-term investment goals include saving for a big purchase that won't be made for another 3 years or less. Medium-term investment goals include saving for a down payment on a property, which could take several years. And long-term investment goals include saving for retirement, which could take many years. What is the connection between your time horizon and risk? Your time horizon and an investment's risk are interconnected. You can generally tolerate more risk if your time horizon is longer. You have more time to recover if an investment doesn't perform as anticipated. For instance, You might take on additional risk when you get your first full-time job and begin saving for retirement. You won't be retiring for many years, so you won't need the money from your retirement investments right now. Because you have a long time horizon, you can continue to make money while managing your investments through market ups and downs. Investing always carries a certain amount of risk. Additionally, certain investments are riskier than others. A higher investment risk may be appropriate for your investment goals. Greater volatility may result from a riskier strategy, but you might gain from larger returns over time. Consider using a less risky investment approach if you have a short time horizon and need the money in a few years. What types of investments are appropriate for your time horizon? Some investment products are best suited for short-term goals. Other investments make sense with a longer time perspective. For a short time horizon investor, investments like cash and short-term bonds have relatively little risk. For instance, let's say you're saving for a trip in 2 years. Cash and short-term bonds can be dangerous for an investor with a long investing horizon. Suppose you are setting up money for retirement. The poor return on short-term investments might not be enough to satisfy your long-term retirement goal or stay up with inflation. When compared, a short-term investor may find investments like stocks to be very risky. That's because their worth can fluctuate a lot. If you invest in stocks while making short-term savings for a trip, you might not return as much as you put in. Over the long term, stocks have a higher potential return than cash or bonds. Stocks may also be a better choice for individuals saving for long-term goals. This is due to the stock market's ability to vary in the short term yet generally exhibit strong long-term performance. Creating a financial plan and budget. Financial planning is how a person can assess their financial situation and prepare for short and long-term financial goals. Financial planning includes more than investment management, such as choosing which stocks to buy. It also includes tax, estate, and insurance planning, as well as budgeting and managing regular home expenses. You most likely had a plan for the most important events in life. For instance, your wedding involved compromise and conversation and adhered to a schedule and budget, even if you went beyond by booking a last-minute table for extended relatives. The logic behind wise financial planning is the same. This section walks you through the steps you need to take to develop a personal financial plan and organize your finances. These tips can help you combine long-term goals with short-term desires, as well as those unforeseen occurrences that happen along the way. For everything from the provisions you need to the retirement you want to the looming car repair expense. With only 9 simple steps, you have a good foundation to build on for the rest of your life. If you've already begun some of these steps, that's fine. Even if you haven't, it's fine. Begin with one task, then move forward. Alternatively, take on the entire steps over a long, rainy weekend with a large pot of coffee and a puppy at your feet. Let's get going. 1. Establish financial goals. Understanding why you save your hard-earned money is usually a good idea. 2. Plan for taxes. A tax plan can significantly increase the money you retain for the upcoming year. 3. Create an emergency fund. Even the best planning won't help if you aren't financially prepared for life's unexpected turns. An emergency fund can be useful in situations like that. 4. Manage debt. An important aspect of developing a financial strategy is understanding and managing debt. 5. Be insured. Invest in insurance since life can change suddenly. Good financial planners hope for the best and prepare for the unexpected. Insurance is useful here. 6. Retirement plan. Consider what you want your money to be able to do for you when you retire, even if it's a long way off, and build a strategy to make it happen. 7. Invest money outside your 401k. Take your savings plan and boost it to help you attain your mid- and long-term goals. Investing can help you do that. 8. Have an estate plan. You don't have to be wealthy, old, married, or a parent to require an estate plan. An estate plan specifies who will make medical and financial decisions for you if you cannot do so. Building a diversified portfolio with index funds. Investing in index funds is a great option for beginners because of its many advantages. For instance, they often have low costs, need little maintenance, and may have built-in diversification. The typical investor often has enough diversification in a simple portfolio of 2 to 3 index funds. These funds are often passively managed, which means no human fund manager makes the investment decisions. Instead, they often try to follow the progress of the S&P 500 index. Of course, this does not imply that index funds are faultless. Giving up most of their control over the assets in their portfolio is the main compromise investors make when using index funds. Additionally, they aren't usually as diverse as one might anticipate. However, index funds can be a great option for beginner investors or people who don't want to spend much time monitoring their portfolios. Here, we'll show you how to purchase the top index funds and take advantage of some major benefits. What are index funds? An index fund is a mutual fund that invests in stocks that closely resemble those in a specific market index. This suggests that the scheme's performance will be consistent with the benchmark index it monitors. An index is a collection of securities that characterizes a specific market sector. Index funds are considered passive fund management since they follow a certain index. The traded securities in a passively managed fund are based on the underlying benchmark. Additionally, passively managed funds do not need a professional group of research specialists to spot opportunities and select the best stock. An index fund is built to replicate the performance of its index, as opposed to an actively managed fund that works more and harder to time and outperforms the market. As a result, the returns of index funds match those of the underlying market index. Except for a little variation, known as tracking error, the returns are roughly equivalent to the benchmark. The fund management often makes an effort to minimize this inaccuracy. Why invest in index funds? The following are some benefits that index funds enjoy. 1. Low costs. Because an index fund mirrors its underlying benchmark, an efficient team of research analysts is not necessary to help fund managers select the best companies. Additionally, there is no active stock trading. All of these elements contribute to an index fund's reduced managing costs. 2. Unbiased investing. Index funds invest via an automated, law-based process. The fund manager's mandate states how much money must be put in various securities index funds. By doing this, human judgment or prejudice in making investment decisions is eliminated. 3. Extensive market exposure. To guarantee that the portfolio is diversified across all industries and stocks, investments are made in a ratio similar to that of an index. As a result, an investor can use a single index fund to capture the likely returns on the broader sector of the market. If you choose to invest in the Nifty Index Fund, you will have access to 50 securities distributed over 13 different industries, from pharmaceuticals to financial services. 4. Tax advantages. Due to their passive management, index funds often have a low turnover or few trades made by a fund manager in a given year. Less trading means that the unit holders receive fewer capital gains dividends. 5. Easier to manage. Index funds are easier to manage since fund managers don't have to worry about how the market treats the stocks that comprise the index. All a fund manager needs to do is periodically rebalance the portfolio. Types of index funds. There are numerous index fund varieties available. Here we will provide you with what you need to know about the different index fund types. Broad market index funds. Investable markets, such as those for stocks, bonds, or other investable assets, are what broad market index funds seek to represent. While index funds that monitor the entire stock market will contain businesses from both sectors, many index funds only follow a subset of the entire stock market, such as the large or small cap universe. Broad market index funds are fantastic if you're searching for low-cost exposure to a whole asset class or a particular nation or region. Market cap index funds. Market capitalization index funds make investments based on a variety of market capitalizations. Companies can be divided based on these numbers, with a company's market cap equal to its outstanding shares' total value. Small cap funds often hold companies with market caps below $2 billion, whereas large cap funds, such as those that track the S&P 500, typically hold companies with market capitalizations above $10 billion. A mid-caps focused fund will fall somewhere in the middle of the two. Equal weight index funds. Most stock index funds are weighted according to market capitalization, which indicates that the fund's portfolio will primarily include the most valuable companies. Although this makes logical sense, it does run the risk of overvaluing a company that makes up a sizable amount of the fund's assets. Equal weight index funds address this problem by holding each account for the same percentage of the fund's assets. Each investment in a fund with 100 holdings will represent around 1% of the total portfolio. Debt and fixed income index funds. There are numerous ways to invest in fixed income or debt through index funds, even though most people generally think of stock investments when they think of index funds. These funds have lower expense ratios than actively managed funds because they follow bond indices like stock funds follow well-known stock market indices. Bonds can be a significant component of your portfolio, particularly as you near retirement. Index funds based on sectors. Sector-based index funds are likely a terrific fit for your portfolio if you have a certain viewpoint on a particular sector of the economy. These funds can be useful for expressing financial opinions without spending time researching specific assets. If you believe that interest rates will continue to rise, you may choose to invest in a fund focused on the financial or technology sectors. International index funds. Since you can purchase a diversified portfolio through a single fund, index funds can be a simple way to expose yourself to geographical regions outside the United States. Even if you are unfamiliar with each company in the fund, you might be interested in investing a portion of your entire portfolio there if you have a favorable outlook for the economy of the nation or region. Accessing economies in Europe or the Asia-Pacific area is made simple by these foreign funds. Socially responsible index funds. Since investors are becoming more concerned with how their money is invested rather than merely the return on their investments, socially conscious index funds have grown in popularity. Some businesses now emphasize environmental, social, and governance issues, and they are represented in indexes that follow equities with that appeal. Some corporations are excluded from other socially responsible indexes due to their commercial activity. New businesses may sell tobacco, alcohol, guns, adult entertainment, or gambling. A step-by-step guide to buying index funds. Investing in index funds is straightforward. You don't need much to get started, and thanks to internet brokers, you can do it in a matter of minutes. 1. Select a broker. Choosing where to invest your money is the first thing you should do. Open an account with the broker who offers the desired fund or with the broker of your choice. Since most of the main brokers provide their index funds, performance should be comparable between brokers since these products often follow the major indices. However, there are minor variations among brokers that might affect your choice. Vanguard illustrates an investor-owned company, which is significant to some investors. The website from Fidelity is usually thought to be easier to use. Others have more sophisticated trading tools, including TD Ameritrade. Choosing the best broker, therefore, involves considering what is most significant to you. You can invest your money any way you choose if you create an account with an internet broker, whatever you select. There are probably thousands of index funds you can choose from. Additionally, you can typically choose between opening a retirement account, like an individual retirement account, IRA, or a brokerage account. 2. Choose your index fund. Choosing which fund or funds will receive your money is the next step. Several well-known index options are available, but most savvy investors would probably stay away from the S&P 500 and U.S. total stock market funds because the latter incorporates the former. A whole stock market index covers all publicly traded firms in the United States, while the S&P 500 only includes around 500 of the largest U.S. corporations. Beyond this, how you distribute your funds is a matter of personal preference. 3. Invest in index fund shares. The hard work is done once you select your broker and funds. All left is to purchase shares. You must still choose how much money to put into each type of fund if you invest in various funds. Younger investors planning for retirement should consider investing a large portion of their portfolio in higher risk products, including stocks, since they have more time before they need the money. However, since bonds and other lower risk investments are less likely to see a short-term decline in value, individuals getting closer to retirement may want to consider putting a bigger portion of their holdings into these types of investments. I hope you are enjoying my audiobook so far. It would be a pleasure if you could let me know how you are feeling about this audiobook in the comments section below. We would greatly appreciate it if you could also like this video and subscribe to United Audiobooks to have access to more best-selling audiobooks in the future. Also, please, if you are interested in getting more free audiobooks, please click the first link in the description below. Now, let us carry on with the next chapter. Introduction to Technical Analysis. Market research and analysis using technical analysis can help traders make more informed decisions. Even though the method has been around for centuries, its popularity has exploded in the last 20 years as data and technologies have become more sophisticated. Thanks to the internet, more people now have access to these tools and are using them to develop their trading strategies. Technical analysis. What is it? In its broadest sense, technical analysis is the examination of markets or securities and past price trends. It is based on the concept that markets often follow predictable price patterns and that these patterns may be recognized and forecasted by looking at historical price movements under similar circumstances or cues. Then, when making a deal, this information can be used. There are numerous theories in trading regarding markets and how to make money from them. One such idea, the efficient market hypothesis, EMH, asserts that it is impossible to beat the markets, since the market price has already considered all pertinent, available information. Even if this hypothesis is correct, no individual could ever understand all facts regarding a market, much less numerous marketplaces. We turn to methods like technical analysis to help us in this situation. How technical analysis works. This section will discuss the 3 fundamental principles of technical analysis. Market activity explains everything. The first principle of technical analysis is the fundamental conviction that the efficient markets hypothesis is true. This means the stock price reflects all information currently accessible regarding a stock's value. When new information that might impact a stock's value is made accessible, the market takes it in immediately and fully, reflected in its price. Pricing changes in trends. The second fundamental tenet is predicated on the idea that prices would keep moving in one direction until a technical indicator signals a turnaround. There are numerous technical indicators, and each investor must decide which one to use. The goal is to spot the trend and stick with it until it shows symptoms of reversing. For instance, an investor might decide to sell a share if the price has been rising, but the technical signal suddenly predicts it will begin to decline. History is cyclical. Last but not least, past patterns in stock price movements tend to repeat themselves. This branch of technical analysis uses market psychology to decipher price chart patterns. It is believed that market psychology, which is the emotion of all investors, determines the ups and downs in asset prices. A security's price will rise when investors purchase it and are upbeat about it. They will sell when their optimism wanes, which will cause the price to drop. How to make investment decisions using technical analysis. Technical analysis is not a skill advisors must possess. However, they must know its expanding importance and ability to help clients understand how price patterns and trends affect their wealth. Any advisor should remember the following essential lessons in technical analysis. Technical analysis has a self-fulfilling prophecy component. Markets have a memory and are aware of previous highs and lows a stock, exchange-traded fund, or interest rate has experienced. Knowing those levels and how to project them into the future is useful, especially given the amount of money currently being spent on technical patterns. It's not difficult to learn the fundamentals, but it takes practice to become an expert who can manage mistakes in judgment while also making or saving money. It goes beyond being a trading tool. Investors often use charts for day trading and other short-term trading, but technical analysis is just as valuable for making investment decisions as any conventional fundamental ratio. It would help if you examined various time frames to utilize the possibilities of charting effectively. Monthly price charts can be useful for understanding long-term trends and pinpointing potential turning points. The finest balance for spotting long-term and short-term patterns is probably found in weekly charts. But understanding charts of daily and hourly prices and even shorter periods is advantageous in today's more volatile and fast-paced market climate. If you're using technical analysis to decide what to invest in for a client portfolio, you might look at longer-term charts to find attractive prospects and short-term charts to help you decide when and how much to invest. Price is the focus of technical analysis, and the price is objective. Investors can go on and on about possible price increases for stocks, the effect of acquisitions, and future earnings growth. All of that is conjecture. What is the real value of security? The cost that you paid for it. Additionally, you have something more concrete than any profit forecast from a sell-side brokerage business if you compile a history of actual prices and learn to understand what those price patterns tell you about the risk versus reward trade-off. Markets are continuously telling stories that technical analysis can decipher. By using price chart analysis, you can listen to the story of the market and use it for the good of your clients. You can start to notice doors open for you if you start bringing this up in conversations with your clients regularly. Option trading for beginners. It would help if you ventured beyond basic transactions and limited stock and exchange-traded fund (ETF) purchases to succeed in the stock market. If you know what you're getting into and how to practice options trading successfully, options trading may provide a path to significant stock market success. Wish to learn more? Let's have a detailed look at options trading for beginners. What are options? An option is a contract for purchasing or selling that grants the owner the right to purchase or sell a security or other asset at a fixed price, either at the contract's expiration date or earlier. Consider an option as reserving the right to buy or sell an asset, like a stock, at a price stated on the option up until the expiration date and time. Keep in mind that this is a right, not an obligation. Typically, options allow investors to reserve the right to buy or sell a stock without committing upfront. This makes it possible for option traders to reduce risk, profit from favorable stock market conditions, and prevent market falls. Option trading can also be compared to placing a wager on the performance of a stock. For instance, if you believe it will rise sharply, you can buy an option to buy a stock at the current price up to a week in the future. If the stock price rises, you can buy it at a bargain and sell it to another investor later for a sizable profit. How does options trading work? Options trading occurs when a person signs a contract to buy or sell stock in a company for a certain price and period. Calls and puts are the two main or fundamental forms of options contracts. A call option offers you the right to buy a stock at a specified price, whereas a put option gives you the power to sell a stock at a stated price. Options trading functions as a result of two parties, namely, 1. Contract holders who buy options. The holders use their option to purchase or sell the underlying shares before the contract expires, or they may let the contract lapse if the circumstances are unfavorable. The risk associated with trading options includes the contract holder forfeiting their initial investment if the contract expires. 2. Sellers who draft or sell the options contracts. Option writers earn from the premiums they charge buyers. It's crucial to remember that options trading involves contracts with strict, definite expiration dates. You may purchase or sell a security or asset up until the expiration date. Consider the situation where you have a call option contract to buy a security for $100 until May 5th at 5 p.m. If you wait until May 6th, you cannot buy the security for $100. Instead, you will have to pay whatever the current market price is. Types of options. Now that the definition of an option has been established, let's examine the call option and the put option, the two different types of options contracts. Call option. A call option is a specific kind of options contract that grants the owner the right, but not the obligation, to purchase a security or other financial instrument at a given price, or the option's strike price, within a given time frame. An option premium must be paid to purchase a call option. As previously stated, the decision to use this option rests solely with the owner. He can let the option expire if he decides it is not lucrative. On the other hand, the seller must sell the securities the buyer wants. While the earnings in a call option can be unlimited, the losses are restricted to the option premium. Let's use an example to grasp further what a call option is. Say a stock of XYZ business is purchased by an investor as a call option on a specified day at a strike price of $100, with an expiration date of 1 month later. The call option holder can still purchase the stock at $100 even if the price increases over $100, say to $120 on the expiration day. A call option allows the holder to purchase the stock cheaply and then sell it for a profit if the security price is expected to increase. Additional call option types include the following three. 1. In-the-money call option. In this situation, the strike price is lower than the security's current market value. 2. At-the-money call option. A call option is said to be at the money if the strike price is less than the current price by an amount equal to the call option premium. 3. Out-of-the-money call option. A call option is deemed out of the money if the strike price exceeds the security's current market price. Put option. The power to sell an underlying security at a certain strike price within the expiration date is provided by putting options to the option holder. This enables investors to set a minimum selling price for a certain investment. The option holder is not required to use the right in this instance. He can sell the investment at market value and forego exercising the option if the market price exceeds the strike price. Let's look at an illustration to grasp further what a put option is. Consider a situation in which an investor purchases a put option from XYZ company on a specific date with a provision that he may sell the share for $100 before the expiration date. He can still sell the stock at $100 even if the share price drops below $100, say to $80. The put option holder is not required to exercise the option if the share price increases to $120. A put option enables a seller to sell the underlying assets at the strike price and reduce his risks when the price of a security is declining. Like call options, put options can also be broken down into in the money, at the money, and out of the money categories. 1. In the money put option. This is when the strike price exceeds the current value of the underlying securities. 2. At the money put option. This is when the strike price exceeds the current price by the same amount as the premium paid for the option. 3. Out of the money put option. This is when the strike price is below the going rate. Based on their exercise, options can also be divided into American and European options. Risks and benefits of options trading. Most options investors' techniques feature limited risk and little reward potential. Options trading has unlimited potential for loss and is not a get-rich-quick scheme. Generally speaking, trades need less capital than identical stock transactions. Instead of equivalent stock transactions, they might repay a higher proportion of the investment rather than lower dollar amounts. Even option holders who employ speculative techniques like writing uncovered calls select to open or close help pop-ups rarely see impressive gains. The maximum profit that could be made is the contract premium. The loss is often beyond the limit. Even while leverage makes it possible for significant percentage profits, less cash is needed than comparable stock purchases. Options are among the most flexible investing options, even though they may not be suitable for all investors. Options can be used for revenue generation, hedging, speculation, bullish, bearish, or neutral strategy. How to start option trading. An option contract grants the holder the right, but not the duty, to buy or sell an underlying asset at a given price, known as the strike price, up to or on a specific date, referred to as the expiry date, via a call option or a put option. Options trading can be right for you if you already trade a specific asset and want to expand into various perspectives on the market. 1. Familiarize yourself with your options. To better appreciate how options might help you encapsulate a market view, you must become familiar with the numerous strategies you can employ and their risk profiles before beginning to trade options. To do this, enroll in an options trading school or read up on the subject in literature. A costly error could be missing an expiration date, being unaware of the level of risk you are incurring, or trading the wrong type or style of option. Therefore, you should carefully check the details and operational mechanics of any options contracts you intend to trade. 2. Connect to the Internet. A somewhat recent computer or mobile device connected to the Internet is practically required because you will typically wish to trade options online using a trading platform. 3. Choose a reputable online options broker. You can trade options through a lot of online brokers. Choose a properly licensed broker that provides options on the asset classes you wish to trade the most, as well as a reliable options trading platform with narrow dealing spreads. You might also need to meet certain requirements to trade options with a specific broker because options are more complicated trading tools. 4. Open an account. Examine the initial deposit needs and account options your preferred broker offers to determine which will fit you best. To ensure that you have enough money to put into your account to cover the options you wish to trade, you should also educate yourself on the broker's margin requirements for various options strategies. 5. Practice trading options. It makes sense to practice trading options in a demo account before trading options with real money. This helps you comprehend the workings of options trading and provides you with a risk-free opportunity to practice using the trading platform provided by your broker. 6. Develop a plan. Considering the risk you'll incur, it's time to create and test a few options trading methods with a reasonable chance of working. Then you may include them in a comprehensive trading plan that describes how you want to run your options trading company and manage your risk capital. 7. Fund your account and start using it. Following these steps will prepare you to start trading options on a live account once you find an opportunity that suits your trading style in the market. Always check that you have enough money on deposit with your broker to use as a margin for your options trading techniques, and only trade with the principal you can afford to lose. Investing in penny stocks. Penny stocks are often the right first stop for novice investors. As the name suggests, penny stocks are businesses that trade with a low share price, always less than $1. It's easy to see why beginners are drawn in by the idea of investing in a business for a few cents and then profitably selling their shares when the price rises to multiple dollars. Due to the incredibly low prices, an investor can own thousands of shares for a relatively small investment. A gain of just a few pennies a share on that scale can result in significant percentage returns. The opposite is also true. But first, a word of caution. Due to their lack of liquidity, significant bid-ask spreads, how much the asking price surpasses the bid price for an asset, low market size, and limited following and disclosure, these stocks are typically viewed as being highly speculative and high risk. Keep reading if you think you're ready to start trading penny stocks. What are penny stocks? According to the Securities Exchange Commission, SEC, any security trading for less than $5 per share is considered a penny stock. Since most of these enterprises are still young, have low market capitalizations, and lack a proven track record of performance, traders and investors should view them as speculative bets. What exactly are penny stocks, then? Well, to begin with, they are inexpensive, so you won't need a lot of money to open a big position, and they often have huge runs of 100% or more in a single day. The promise of earning such large profits has drawn new traders of all stripes, which explains why they have become so well liked. Due to the volatility of penny stocks, it is equally easy to lose all your money or even more if you are trading on margin. Before jeopardizing any of your hard-earned cash, learning how to trade them and what to look for is crucial. How do penny stocks work? Penny stocks trade like any other stock while bearing increased risk. Penny stocks shift hands less often due to smaller volumes, making these investments less liquid. Penny stocks are risky investments due to their increased price swing susceptibility and other variables. Penny stocks are made up of extremely speculative, unproven companies and bear significant risk due to their low price per share and smaller market capitalization. These stocks offer less information due to less coverage from major institutional investors, making it more difficult to make wise trading decisions. Information is often less reliable because they are not obligated to file with the SEC, making it harder to trust. With fewer shares of these companies changing hands daily than common stocks, penny stocks are also considered illiquid investments. The likelihood of not finding a buyer and selling at unfavorable pricing rises when there is less liquidity. In addition, these businesses are often the target of price manipulators who buy a lot of stock before artificially inflating the share price with false and deceptive positive remarks, a practice known as pump and dump. The benefits and drawbacks of trading penny stocks. The ability for traders to diversify their portfolios without investing a lot of money is one of the main benefits of these stocks. They are affordable, have good return potential, and can even help traders increase their risk tolerance as they advance their undertakings. However, volatility might be a problem even when you locate a reliable stock to trade with. Losses can often exceed your expectations because prices can collapse quickly and unpredictably. Since many penny stocks are produced by businesses looking to make a quick profit, it can be difficult to estimate their true value. Long-term viability is also unlikely. How to find and research penny stocks. There are numerous locations where one can purchase a cart full of penny stocks. Finding them is easy. Selecting the best ones is difficult. Okay, now that you understand what penny stocks are, you've concluded that the penny stock market is suitable for you. You could ask how to find penny stocks, where to start, and how to purchase penny stocks. This is the challenging stage since a lack of research and an impulsive purchase might result in expensive errors and losses. It's challenging to find the best penny stocks. The likelihood of success will be considerably increased by taking the time to investigate penny stock lists and obtain data on specific businesses. It is not advisable to buy a penny stock because a coworker who overheard someone gushing about it on the bus suggested it. So, you are now thinking about where to buy penny stocks and how to research penny stocks. Lists of top penny stock investments may be found on many websites. Here it is critical to approach cautiously and can distinguish between penny stocks that are real and those that are the targets of pump and dump schemes. The first step is to find a website that lists penny stocks. The Investing Ideas page on Wall Street Survivor, which features a list of several penny stocks, is a fantastic place to start. Use MSN's Stock Screener as an additional tool to filter equities based on desired factors like share price. But it's also crucial to understand where to look for good penny stocks. Make sure to research each business after looking through several online lists. A fundamental or technical analysis technique can be used to analyze businesses. The latter is more typical for penny stocks. How to trade penny stocks. You've heard the cautions, yet you still want to trade penny stocks despite that. Today, profitable penny stock trading is still achievable. But first, you must educate yourself. Then you can start trading. To trade penny stocks successfully, you must be a knowledgeable investor familiar with the market. Penny stocks can have the best risk-reward ratio of any investment if you trade them correctly. The second thing you must do is avoid con artists. Read the small print on any email or advertisement you encounter on social media or in emails. The phrase, pennies to dollars instantly, is a terrific introduction to the topic of your greatest suffering. A colleague may suggest pink sheet stocks for their low value, or you may come upon an OTC stocks list that piques your interest. On the other hand, you might have discovered a high-quality investment. OTC MKTS stocks, on the other hand, can be fatal. 1. Register for a live trading account. Then register to begin trading penny stocks. Open a live account here if you're on a desktop to spread bets or trade CFDs on the price changes of penny stocks. 2. Load your account with money. Adding money to your account is simple with a bank card, bank transfer, or PayPal. 3. Do some research to identify the best stocks for you. To help you in penny stock trading, consult our news and insight tools and our news and analysis area. 4. Choose whether you wish to sell or buy. Depending on your trading approach, decide where to enter and leave. If you believe the instrument price will increase, go long and buy, or go short and sell if you are certain the price will decrease. 5. Limit your risk. Ensure you are following your strategy's risk management criteria before placing your trade. 6. Place the trade after deciding the amount of your position. Apply risk management orders, including take profit and stop loss orders, and then confirm your trade. 7. Keep an eye on your position before closing the deal. Stick to your trading strategy and exit when the goal price is reached if your investment in a penny stock is profitable. Dividends investing. One of the finest methods to invest is by purchasing the shares of firms that consistently pay dividends. Some could even describe dividend investing as dull because you're investing in more established companies for gradual, dependable payments. However, consistent gains are never monotonous. There are still many advantages to a dividend investing approach, even if earlier generations of investors preferred it since they generally received bigger yields than are currently available. What are dividends and how they work? Dividend payment transfers a company's profits to its shareholders, stake owners. Let's examine a case in point. Consider purchasing 100 corporation shares for $10 apiece, with each share paying a 50-cent annual dividend. Over a year, a $1,000 investment would yield $50 in dividend payments. That amounts to a 5% dividend yield, which is not bad. It is up to you what you decide to do with your dividends. You can acquire stock in another firm, invest the funds automatically in more company shares through a dividend reinvestment plan, DRIP, save the funds, or spend them. You would continue to get those dividend payments as long as the firm kept paying them out, regardless of whether the company's stock price increased or decreased. The appeal of dividend-paying stocks is that a portion of your return comes from dependable quarterly payments. A diversified portfolio of dividend stocks can generate consistent income in all weather conditions, even though not every firm issuing dividend stocks can continue a dividend distribution in every economic climate. When you combine those dividends with capital growth brought on by the increasing value of your businesses, your overall returns may even be greater than those of the general market. Investing in dividends. Pros and cons. Dividend investing has advantages and disadvantages when used to generate passive income. Let's examine them. Pros. 1. Investors who want to routinely create more income without actively making investment decisions might consider the dividend investing method. In other words, it can provide a steady source of revenue. 2. If the price of dividend equities rises over time, they may also give owners capital appreciation. 3. Because dividends of well-established companies do not considerably fluctuate due to changes in the economic environment, this method guarantees protection from the stock market. Cons. 1. dividends aren't always promised. A business may opt to stop paying dividends altogether. Alternatively, they could decide to cut their payout. 2. The eventual ceiling of returns is yet another drawback of dividend investment for passive income. Given the state of the economy, not even the most reliable businesses that pay out big dividends have an annual return of more than 10%. However, there are several exceptions. 3. Companies with exceptionally high dividend yields could look enticing, but they will likely cut their payout. People must therefore weigh this danger and stay away from high-yield dividend traps. How to identify dividend-paying stocks. One method for identifying the top dividend-paying stocks is dividend yield. Many websites focus on high-yielding dividend stocks, but focusing only on the dividend yield alone might be misleading. Look at a stock that, until recently, was valued at $100 per share and paid $5 in annual dividends. However, the company's operations faced difficulties, and its shares dropped to $50 even though it continues to distribute $5 in dividends annually. The dividend yield would have quadrupled to 10% quickly from 5%. In this instance, an increasing dividend yield is not indicative of a thriving corporation, but rather a symptom of stress. If a company's stock price falls, it might have issues, and the board might want to rethink the dividend. This emphasizes the need for reliability when choosing dividend-paying equities. Is this business stable enough to continue paying the promised dividends, and perhaps even gradually increase them over time? Firms in the dividend aristocrats, a group of firms that historically have grown dividend payments over time, are one location to search for dependable dividend stocks. The average dividend payment for stocks in certain industries, such as utilities and real estate, may also be greater. The dividend payout ratio, which takes volatile stock prices from the picture by comparing a company's earnings to its dividend payment per share, is another metric for identifying high-quality dividend companies. A company's payout ratio is 50% if it earns $2 per share in a particular quarter and distributes a dividend of $1 per share. Lower payout ratios should indicate less volatile dividends. Alternatively, a low payout ratio may signal that a corporation needs to raise its dividend. A corporation may need to reduce its dividend if its payout ratio exceeds 100%, since it gives shareholders more money than it makes. It also means that its earnings are under pressure. On the other hand, a constantly increasing payout ratio could signify a strong business operating in a stable sector. How to build a dividend portfolio. The 6 steps to building up your portfolio are as follows. 1. Spread out the good stocks you own. Remember that you are investing for future income needs, not to make King Solomon's fortune out of your money. In light of this, leave the highly targeted portfolio management to the individuals who live and breathe equities. The primary goal should not be growth, but dividends. You are not required to take business risks. 2. Include 5 to 7 industries in your weighting to increase diversity. Having 10 oil firms is wonderful, as long as oil doesn't drop to $10 per barrel. The major objective is dividend stability and growth. Hence, a reduction should be avoided. If your dividends are reduced, confirm that it is not a widespread issue that affects all your securities simultaneously. 3. Select stability above development in your finances. The best situation is to have both, but when in doubt, having more financial resources is preferable to experiencing more portfolio gain. The credit ratings of a corporation can be used to gauge this. All stocks in the Value Line Index are rated by the Value Line Investment Survey, from A++ to a D. For the least risk, concentrate on the A's. 4. Look for businesses with reasonable payout ratios. This is the dividend-to-earnings ratio. To leave room for error in the event of unforeseen business problems, a payout ratio of 60% or less is preferable. 5. Look for businesses with a track record of increasing their dividends. When it paid out 1 cent per share in quarterly dividends in 2011, Bank of America's, BAC's, yield was only 0.1%. With a 21-cent quarterly payment in 2021, a 20-time increase, the dividend yield has risen to 2.2% 10 years later. That is how it is intended to operate. The S&P Dividend Aristocrats list, Mergent's Dividend Achievers, and the Value Line Investment Survey are good locations to start looking for portfolio candidates who have increased their dividends yearly. Assuming the business remains profitable, companies that consistently increase their dividends have a tendency to do so in the future. 6. Dividends are reinvested. Reinvest the dividends if you begin investing for income well in advance of the time you will need the money. With just one step, you can unexpectedly increase the growth of your portfolio with little work. While not ideal, the dividend strategy gives us a better chance to outperform inflation than a bond-only portfolio over the long run. It is ideal if you have both. Investors looking for an assured 5% return without risk ask for the unattainable. Like looking for an insurance plan that will always protect you, such a thing does not exist. Low but consistent inflation makes hiding money in the mattress impossible. Investors must take risks whether they like it or not because the only way to avoid inflation is through growth. Real Estate Investment Trusts, REITs. REITs reward investors with a tempting alternative to conventional exit plans. Traditional real estate investors spend their time purchasing and selling real estate assets. Real estate firms and their corresponding dividends are of greater interest to REIT investors. Given that REIT investing has demonstrated its ability to help investors at all levels, many questions arise, including, what is REIT investing? Do REITs make wise investments? What REITs are the most often purchased? Below are some explanations for these questions and others. What is a REIT? A REIT corporation owns and often manages income-producing assets, such as real estate. NAREIT broadens this definition also to include businesses that lend money for properties with an income. Some REITs' organizational structures let people buy actual real estate even though they probably couldn't afford to do so on their own. After all, spending tens of thousands of cash, if not millions, on buying and maintaining tangible real estate assets is not difficult. REITs often hold many properties and can invest in various real estate types. This lessens the danger that your investment will suffer from a single tenant not paying the rent or a property losing value. Typically, REITs provide investors two ways to make money: dividend payments from the cash left over after paying expenses and receiving rent, and capital appreciation or a rise in the value of the real estate the REIT owns. Naturally, each REIT operates differently, so not every REIT will benefit from both gains. Investing in REITs has the same risk as other types of investments. How REITs work. REITs work in various ways depending on the sort of REIT you invest in. REITs often invest in one or more different types of real estate. Examples are residential real estate, whether single-family or multifamily, offices, shopping centers, inns, data centers, warehouses, and other amenities. While some REITs engage in various real estate markets, others concentrate on a single category, such as commercial real estate. When you invest in a REIT, you acquire a stake in the business that manages the actual real estate properties. Publicly traded REITs are one of the most prevalent kinds of REITs. These REITs can be bought and sold during market hours, much like shares on the stock market, because they are traded on open stock exchanges. The REIT expertly manages the real estate. When deciding when to sell the real estate assets, it searches for potential real estate to buy. It might even oversee the renters of the property. The REIT must pay the person that oversees the properties and contractors for this management, which has a cost. Due to this, REITs often impose expense ratios. Some might also charge for purchase costs upfront. You gain the advantage of holding stock in the business by investing in a REIT. You are compensated when the REIT chooses to distribute earnings as dividends. You might be able to sell your REIT shares to lock in the gains if the REIT increases in value due to the rising real estate values it holds. While some REITs are subject to SEC regulation, some are not. What kinds of financial statements and other details the company must provide to its investors may be specified by the regulations. If you invest in an unregulated REIT, you might not receive as much timely information about your investment. Types of REITs. Equity REITs make up the majority of REITs. These real estate firms hold homes or businesses and oversee their management on behalf of investors. These REITs enable private individuals to buy REIT shares on stock exchanges. As an investor, you have a variety of REITs to pick from that invest in various real estate types. Here are a few well-liked choices you might find. Retail REIT. Property that is leased to commercial enterprises is owned by a retail REIT. The real estate investment trusts, REITs, in question may be the owners of strip malls, traditional shopping malls, grocery store shopping centers, and enormous big box retailer anchored shopping centers. Residential REIT. Residential REITs concentrate on homes and other dwellings. They generate income by owning the properties and leasing them to tenants. These homes may be single-family residences, apartment complexes, mobile homes, or even accommodations for college students. These REITs may concentrate on various residential real estate types or just one. They might also focus their assets in certain areas they believe provide potential opportunities or diversify their real estate holdings throughout several locales. Office REIT. Office REITs are property owners specializing in commercial office space. To make money, they rent out this office space to tenants. Large-scale office buildings, such as skyscrapers, to small office parks in suburban locations are typical types of office spaces controlled by these REITs. Similar to residential REITs, these might concentrate on a particular subset of this kind of property. Others can concentrate on office space designed for a specific tenant demographic. Alternatively, they can concentrate on office space in a certain nation region. Healthcare REIT. This type of REIT buys and leases property that specializes in providing healthcare services. This can include medical office buildings, hospitals, assisted living facilities, nursing homes, and more. This form of real estate presents a special investment opportunity because the tenants often have particular needs for their properties. Mortgage REIT. In contrast to the above choices, a mortgage REIT, sometimes called an MREIT, is unique. This kind of REIT makes investments in mortgages rather than owning actual real estate. Most real estate purchases are backed by mortgage debt. REITs can create their own mortgages or buy mortgage-backed securities, which are collections of mortgages. Due to the REIT's ownership of the mortgage, all principal and interest on the REIT's loans must be paid by the mortgage borrowers to the REIT. How to invest in REITs. As previously said, you can buy shares of a REIT listed on significant stock markets. A REIT mutual fund or ETF share can also be purchased. You must create a brokerage account to do this. Alternatively, if your employer-sponsored retirement plan allows for REIT purchases, you can consider doing so. To learn more about the available REIT investments, speak with your plan administrator. The procedure is simple if you open a brokerage account and don't already have one. You must include personal information, such as your social security number and a valid ID, and basic contact information. Additional questions regarding your income, profession, and prior investing experience will be required from you. Depending on your choice, you may join up for a broker's services online, using a mobile app, or in person at a branch. Utilize the education and research sources at your disposal after your account is set up and accessible online to start evaluating potential REIT investments. A screening tool that can help you hone your research and selection should be included in your brokerage account. Once you've determined which REIT investment best suits your requirements and objectives, you can buy it online. Before you proceed, be sure you know the types of fees your broker may impose and any fees or charges related to the investment, such as fund expense ratios. You should periodically examine your REIT investment, just like your other investments. Risk management and portfolio optimization. Risk management, in the context of finance, is the process of recognizing, analyzing, and accepting, or minimizing, uncertainty in investment decisions. Risk management is the process by which a fund manager or investor assesses and makes an effort to quantify the possibility of losses in an investment, like a moral hazard, and then decides what course of action, or inaction, to pursue in light of the fund's investment goals and risk tolerance. Risk and reward go hand in hand. Every investment has some level of risk, which in the case of a United States T-bill is close to zero or extremely high for something like emerging market stocks or real estate in markets with significant inflation. Risk can be measured at both absolute and relative levels. Investors can better understand the opportunities, trade-offs, and costs associated with various investing strategies if they have enough of a thorough grasp of risk in all of its forms. Effective ways to manage your portfolio risk. Investment inevitably involves some level of risk. Risk is a major factor in determining the results you expect from your portfolio. Although you can decide how much risk you wish to face when investing in a fund, that risk level may change over time depending on the market and economic environment. In addition to market conditions, you might wish to adjust your portfolio's risk as your goals and risk tolerance change. While making a profit is the ultimate goal of your investment, you cannot maximize your returns until you modify your risks per your needs. So, here are the top 7 ways to control portfolio risk. 1. Create a plan for the largest possible loss. The losses that hurt the most are the ones you weren't prepared for. Therefore, preparing for and anticipating such severe losses would be the most important measure. Many equity investors struggle to determine how severe losses will be, leaving their portfolios open to bear markets and rapidly deteriorating economic conditions. Making wise investing selections would be helped by having a probable maximum loss plan that would allow you to see the danger your portfolio faces in extreme loss markets. Additionally, it will support you in taking calculated risks that are appropriate for your risk tolerance and consistent with your long-term investing strategy. It would help if you examined the portfolio's asset allocation and value to deconstruct the potential loss strategy further. By regularly appraising your holdings, you can only understand the risks that could engulf your portfolio and the modifications you need to make to lower any such risks. Let's get into further detail at the point after this. 2. Ensure careful asset allocation. One of the most basic strategies to minimize the risk in your portfolio is through efficient asset allocation, diversification. While asset allocation discusses the large picture and how one asset's risk complements or offsets the risk of another in your portfolio, the focus should be on specific securities while investing in assets. To locate and invest in undervalued assets, conduct thorough research or, if necessary, conduct a professional portfolio analysis. Your investment discipline should be centered on active portfolio allocation. Even if you are happy with how you divided your investments across different investment groups and classes, you must constantly evaluate your portfolio and adjust your objectives and market conditions. Keep an eye out for significant price changes because they are a signal to adjust your asset portfolio. 3. Make sure you have a safety margin. A margin of safety is important for the portfolio as a whole and for each investment in it. What is the safety margin? Simply put, it is the gap between a security's intrinsic value and the price you paid for it. The higher your margin of safety, the less risk you must take. With a good margin of safety, you can experiment, make mistakes, and deal with harsh economic conditions. Creating a margin of doubt would also involve purchasing stocks of reputable businesses with a track record of success and sound financials and investing in inexpensive stocks or receiving enormous discounts. 4. Do not expose your portfolio to volatility. On the surface, portfolio volatility may appear unimportant to a beginner because it is balanced. For instance, a simple arithmetic average will show you received 0%, apparently no harm done, if your portfolio had positive returns of 50% and negative returns of 50%. If you analyze correctly, you have lost 25% of your wealth. Therefore, more volatility over the long term might significantly reduce the returns on your portfolio. Because less volatile portfolios typically outperform more volatile ones, it only makes sense to balance your portfolio's volatility. 5. Put liquidity first. It would help if you considered duration risk when planning your risk reduction strategy, which means that over time, some investments may become more susceptible to movements in the stock market. Additionally, liquidity is essential since cash enables you to profit from market cycles. For example, if the market is about to experience a severe fall and even desirable equities are offered at steep discounts, you won't be able to buy them if you don't have cash. As a result, you must constantly consider liquidity while developing your portfolio risk plan. 6. Stop thinking emotionally. Since we are all emotional beings, our actions and choices are influenced by our emotions. However, while investing, there is no room for emotional judgment. It is solely a game of numbers. Don't base important financial choices on rumors or news headlines. Make sure you build your portfolio following a thorough risk analysis and considering the connection between the items in your portfolio. 7. Examine your timelines. Keep in mind that investing is a marathon, not a sprint. When investing, keep the long term in mind rather than trying to outperform the market quickly. Ensure your investment deadlines are accurate and per your financial and personal objectives. Rushing to outperform the market could result in substantial portfolio losses. How to optimize your portfolio for maximum returns. The success of any investor depends on having a well-diversified portfolio. As an individual investor, you must understand how to choose an asset mix that best fits your unique investing goals and risk tolerance. In other words, your portfolio should provide peace of mind while meeting your future cash needs. Using a systematic process, investors can build portfolios that align with their investment strategies. Here are a few crucial actions for using such a strategy. 1. Choosing your appropriate asset allocation. Determining your unique financial condition and aspirations is the first step in building a portfolio. Age, time you have to build your investments, the number of funds to invest, and future income requirements are all crucial factors to consider. A 55-year-old married individual intending to help pay for a child's college education and retire in the following 10 years needs a different investing approach than an unmarried 22-year-old college graduate just starting their career. Your personality and risk tolerance are a second factor to take into account. Do you want to take that chance on maybe losing some money in exchange for a chance at bigger rewards? Everyone wants to earn big returns every year, but if you find it difficult to fall asleep when your investments experience a temporary decline, the high returns from those kinds of assets are likely not worth the worry. 2. Developing the portfolio. It would help to allocate your capital among the relevant asset classes once you have chosen the ideal asset mix. This is not complicated. Stocks are stocks, and bonds are bonds. However, you may further divide the various asset classes into subclasses, each with a unique set of risks and potential rewards. An investor might, for instance, distribute the equity element of the portfolio among companies with various market capitalizations, industrial sectors, and domestic and foreign equities. The bond component may be divided between short-term and long-term bonds, government and business debt, etc. 3. Re-evaluating portfolio weightings. Once your portfolio is in place, you should periodically review it and rebalance it because changes in price movements may cause your initial weightings to shift. Calculate the investment's relative values to the total and objectively categorize them to get your portfolio's actual asset allocation. Your current financial condition, future demands, and risk tolerance are other factors that could change over time. You might need to modify your portfolio if these factors change. You might need to hold fewer stocks if your risk tolerance has decreased. Or maybe your asset allocation dictates that a little portion of your assets be invested in riskier small-cap stocks because you're now ready to take on additional risk. To rebalance, find out which of your positions are overweighted and underweighted. For instance, your asset allocation indicates that you should only have 15% of your assets in small-cap shares, but you already have 30% of such securities. Choosing how much of this position to diminish and distribute to other classes is part of the rebalancing process. 4. Strategic rebalancing. Choose which underweighted securities you will purchase with the money from selling the overweighted securities after determining which securities you need to reduce and by how much. Use the methods covered in Step 2 to select your securities. Even though your growth stock investment may have increased significantly over the past year, you might be subject to hefty capital gains taxes if you sell all your equity investments to rebalance your portfolio. In this situation, it might be more advantageous to stop making future contributions to that asset class while carrying on with contributions to other asset classes. This will gradually decrease the percentage of growth stocks in your portfolio without triggering capital gains taxes. Always keep in mind your securities outlook at the same time. You might wish to sell those same overweighted growth companies despite the tax repercussions if you believe they are ominously about to fall. Research papers and analyst forecasts can be helpful tools for assessing the outlook for your assets. Additionally, you might use the tax loss selling approach to lessen the tax impact. You must prioritize maintaining your diversification throughout the entire process of building your portfolio. You must diversify within each asset class and merely own securities from each one. Ensure your investments in a particular asset class are dispersed throughout various subclasses and industry sectors. As we previously discussed, using mutual funds and ETFs allows investors to attain good diversification. With the help of these investment vehicles, little cash individual investors can benefit from the same economies of scale as institutional investors and huge fund managers. Putting it all together, your investment plan. Your first house purchase or being prepared for retirement are crucial financial milestones that may be attained with a well-thought-out investment plan. It can also help you prepare for the typical ups and downs of the market and help you seize opportunities as they present themselves. Creating a personalized investment plan. There is more to creating an investment strategy than merely picking a few stocks. It would help to consider your present financial status and long-term goals. To determine your ideal asset allocation, it's also crucial to specify your time frame and the risk level you're willing to take. All of these actions help reduce any danger you might have in the stock market. Planning before you invest your money is, thus, a very prudent decision. To help you understand your financial situation, you might need to do a lot of study or speak with a financial counselor. 1. Assess your current financial situation. Defining your current financial condition is the first step in creating an investment plan for the future. Determine how much money you have available to invest. Creating a budget will help determine your monthly discretionary income after spending and emergency funds. You can then calculate how much you can invest on a reasonable basis. It's also crucial to think about how liquid or accessible you need your investments to be. If you need to cash in on your investment quickly, invest in more liquid assets, such as stocks, rather than real estate. 2. Establish financial objectives. Defining your financial objectives is the next step in creating an investing plan. What motivates you to invest? What do you intend to buy with your money? This could be anything from planning to buy a car in a couple of years to retiring comfortably in a few decades. You must also specify the time frame of your goals. How soon do you expect your investments to yield a profit? Are you more interested in long-term investment growth or accelerated growth? Your goals can be categorized into 3 basic groups: safety, income, and growth. You are seeking safety when you want assets to generate current income so you can live off of them. You seek income to live off them when you want investments to generate long-term wealth growth. You can decide which investment strategy is ideal for you depending on which of these three categories your goals fit into. 3. Establish your time horizon and risk tolerance. Choosing how much risk you are willing to take will be the next step in developing your investment strategy. You can take more risks when you're younger because your portfolio will have more time to recover from losses. Older investors should look for less risky products and invest more money up front to promote growth. Furthermore, riskier investments have the potential to provide big returns as well as sizable losses. Taking a gamble on a cheap stock or plot of land could pay well or result in a loss of capital. If you want to accumulate wealth over time, you can choose a safer investment strategy. Compared to its risk equivalent, determining your time horizon is very straightforward. The term refers to the timing of your initial withdrawals from your investments to reach your long-term financial goals. Time horizon effectively means retirement to the great majority of Americans. You can create a dependable asset allocation by determining your risk tolerance and time horizon. Using your investor profile, you can determine what to invest in and how much of your entire portfolio each investment should account for. 4. Select an investment. Making an investment decision is the last stage. You have access to a lot of accounts for your assets. Your financial situation, objectives, and level of risk tolerance will all be factors in helping you choose the best investments. Think about investing in stocks, bonds, mutual funds, 401k and IRA plans, bank savings accounts or certificates of deposit, CDs, and 529 savings plans for college. Real estate, fine art, and other tangible goods are all options for investment. Regardless of where you decide to invest, diversify your holdings. You don't want to invest all of your money in stocks and risk losing it all, say, if the stock market crashes. To maximize your stability and growth, dividing your assets over a few different investment categories matching your goals and risk tolerance is best. When you get to this point in the procedure, it might be time to talk to a financial advisor. An advisor can help you select the best investments for your money based on your goals and present financial situation. 5. Observe and rebalance your investments. It's not a good idea to leave your investments alone after making them. You should periodically review your investments to determine how they are doing and whether you need to rebalance. For instance, you might not be investing enough money each month and, therefore, not be on track to meet your goals. Or you might be investing more than you should and thus be ahead of schedule. If your investments are doing well and you want to take on more risk to achieve your goals sooner, you may want to switch your money to a more secure investment as you approach closer to attaining your long-term goals. When you believe your investment strategy is sound, you should rebalance your portfolio. This entails returning the asset allocation in your portfolio to the original composition. Let's imagine, for example, that your stock investments outperformed the rest of your portfolio by a wide margin. It can make sense to reinvest the proceeds from selling some of your equities and other investment categories to maintain your right asset allocation. Bonds, CDs, ETFs, and other investments may be among them. Achieving financial freedom through smart investing. Financial freedom is when you know your needs and wants can be satisfied without experiencing financial stress. It entails being free to make decisions about your life without being constrained by financial obligations, such as changing employment, traveling, or engaging in hobbies. Long-term goals like financial freedom necessitate preparation, diligence, and astute financial decisions. Investing is one of the finest strategies to gain financial independence. Here are some ways investing can help you in achieving financial freedom. Start your investments early. Metrics for investing and the early bird gets the worm agree. When you start investing early, you allow your investments enough time to increase through the force of compounding. You don't need to invest much money. Even little yet secure investments can help you build wealth and increase your future financial security. Whatever your age, it's never too late to start. Compounding returns. Over time, your assets could expand dramatically thanks to the magic of compounding. You can earn interest on your major and cumulative investments by reinvesting investment returns. Your investments can grow dramatically over time in this way. Diversification. You can spread your risk and reduce losses by investing in various assets, such as stocks, bonds, mutual funds, ETFs, or commodities. The benefit of diversification is that it prevents you from placing all your eggs in one basket. Be patient. Patience and discipline are necessary for investing. Although it may be tempting to focus on short-term gains in unpredictable markets, it's crucial to maintain your long-term objectives. When the market slumps, resist the impulse to sell your investments and wait for it to turn around. Keep up. Keeping up with current business news, economic situations, and market trends is critical. This can help you in making wise investment choices and prevent costly errors. Set your budget. Create a budget that keeps track of your earnings and outgoings. This will assist you in finding areas where you can minimize your expenses and maximize your savings. Continue to invest. Make regular investments in assets that fit your risk appetite and long-term objectives. You can practice investing without risking your money by using a virtual trading program like StockP. Conclusion. It can be daunting for beginners to learn how to invest in stocks, but it just involves deciding which investment strategy you want to follow, what kind of account makes sense for you, and how much money you should invest. If you're starting as an investor, you can invest in stocks with a fair amount of cash. You will need to research to ascertain your investment goals, risk tolerance, and the expenses related to stock and mutual fund investing. Additionally, it would be best to research several brokers to see which can best meet your demands and understand their unique requirements. Once you do, you'll be in a good position to benefit from the significant financial upside that stocks can offer you over time.
We appreciate you tuning in to one of our captivating audiobooks. For more immersive experiences, here is another audiobook we're certain you'll enjoy. Don't forget to show your support by liking this video, sharing what you loved about this audiobook in the comments section below, and subscribing for more captivating audiobooks like this. Thanks for being a part of our audiobook community.